Very good morning to you all. Today we will start a new topic which is called differential analysis or incremental analysis. The topic that we will start to discuss it today is called differential or incremental analysis. After studying this chapter, a student should be able to firstly indicate the steps in management's decision-making process, describe the concept of incremental analysis, identify the relevant cost in accepting an order at a special price, identify the relevant cost in a make or buy decision, give the decision rule for whether to sell or process materials. What is the incremental analysis approach? Here we need to define the incremental analysis approach. The definition of incremental analysis approach: decisions involve a choice among alternative actions. Of course, when the decision maker make a decision, he or she choose from among alternative actions. And financial data relevant, suitable to a decision are the data that vary in the future among alternative. Financial data play a vital role. Financial data suitable, relevant to a decision are the data that vary. We need to concentrate on vary in the future among alternative. Both costs and revenue may vary among alternatives. Both costs and revenue may vary under alternatives. Among alternatives, only revenue may vary among alternatives. Only cost may vary among alternatives. Here we face three cases. The first case, that both cost and revenue may vary among alternatives. Secondly, the second case, only revenue may vary among alternatives. Thirdly, only cost may vary among alternatives. Incremental analysis is the process used to identify the financial data that change under alternative course of action. It identifies probable effects of decisions on future earning. Identify probable effects of decisions on future earnings for the company. Also, it's called differential analysis because it focuses on difference among alternatives. So, incremental analysis is a process. Incremental analysis is a process used to identify the financial data that change under alternative course of action. It identifies probable effects of decision on future earnings. Also called differential analysis because it focuses on differences among alternatives. It focuses on difference among alternatives. So here we did mention the definition, the meaning of what is the incremental analysis approach or what is the differential analysis approach. Here we have two alternatives, alternative A and alternative B, and the difference between these two alternatives: net income, increase or decrease, revenue, cost, and net income. by comparing an alternative B with alternative A. Alternative A is a base. We compare alternative B with alternative A. We conclude the following results. Incremental revenue is $15,000 less under alternative B. Revenue under alternative B is less than under alternative A by $15,000. Incremental cost savings, $20,000 is realized. Here we have cost saving of $20,000 is realized. So net income under alternative A, $25,000, under alternative B, $30,000. The difference here is $5,000. Alternative B produces $5,000 more net income. We did mention a comparison of alternative B with alternative A. Alternative A is a base. We compare alternative B with alternative A. We conclude the following results. Incremental revenue is $15,000 less under alternative B. Revenue. However, incremental cost savings of $20,000 is realized. Cost saving under alternative B, $20,000 cost savings. So here net income under alternative A, $25,000, under alternative B, $30,000. So alternative B produces $5,000 more net income. The incremental analysis sometimes involves changes that seem contrary to intuition. More specifically, variable cost sometimes don't change under alternatives. Sometimes variable cost don't change under alternative. On the other hand, fixed cost sometimes change. Fixed cost sometimes change between alternatives. So these changes seem contrary to intuition. Incremental analysis not the same as cost volume profit analysis. We did study cost volume profit at the first semester in the course of managerial accounting. There is a difference between incremental analysis approach and cost volume profit analysis. The types of incremental analysis are as follows. We here have 6 types of incremental analysis. The first type, to accept an order at a special price. Accept an order at a special price, which is less than normal price for the product of the company. Make or buy, sell or process further, retain or replace equipment, eliminate an unprofitable business segment, allocate limited resources. Today, we will discuss only the first 2 types of incremental analysis. Accept an order at a special price and make or buy decision. Accept an order at a special price. Accept an order at a special price. We need to understand this carefully. An organization may obtain additional business by making a major price concession to a specific customer. An organization may obtain additional business by making major price concession, major price reduction to a specific customer. Here it's assumed that sales of products in other markets are not affected by special order, and the organization is not operating at full capacity. Here we need to make a decision under these two conditions. Firstly, it's assumed that sales of products in other markets are not affected by a special order, and the organization is not operating at a full capacity. Here is an example. A customer offers to buy a special order of 2,000 units at $11 per unit. Additional business, special order. Additional business, special order. Customer offer to buy a special order 2,000 units of our products at $11 per unit. Additional information is as follows. No effect on normal sales. Condition number 1. No effect on normal sales. No effect on plant capacity, currently operating at 80%, which is 200,000 units. So the plant does not operate at a full capacity. Its capacity here currently operating at 80%, which is 200,000 units. These are the two conditions. Current variable manufacturing cost $8 per unit. Current fixed manufacturing cost 800,000 or $4 per unit. 800,000 divided by 200,000 units equal $4 per unit. So obviously, total cost is $12 per unit, $8 variable and $4 fixed. On the other hand, the selling price, the special selling price is $11. So obviously we have to reject this offer because cost is $12, $8 variable cost and $4 fixed cost, $12. And the special price is $11. So the cost is over the selling price. So we have to reject offer based on total cost of 12 per unit. Reject offer as cost exceeds selling price of $11. Fixed cost don't change since within existing capacity. Thus, fixed costs are not relevant. Not relevant data. Because fixed costs are not change. Don't change. Fixed costs don't change since within existing capacity. Thus, fixed costs are not relevant. Variable manufacturing cost and expected revenue change, thus both are relevant to the decision. We have to take into consideration these two kinds of items: variable manufacturing cost and expected revenue change. So both are relevant to the decision. Here, under the first alternative, reject an order, revenue 0, cost 0, net income 0. Under the alternative of accepting the order, revenue $22,000, $2,000 units multiply 11. 2,000 units multiply $11. 22. And 16,000 cost. Variable cost $8. So 2,000 units multiply $8, $16,000 variable cost. So the net income will be $6,000. 22 cost 16,000 and net income will be 6,000. So in this case, we have to accept the offer. Income increases by $6,000. The second type of incremental analysis is to make or buy decision. The decision here is to decide, to make a decision whether to make the component parts or to make the component parts or to buy them from others. We have two alternatives, to make or to buy. What component parts of the final product, component parts of the final product, to make the component parts or to buy them from others. Example, the following costs are incurred to make 25,000 switches. Direct material, 50,000. Direct labor, 75,000. Variable manufacturing overhead, 40,000. Fixed manufacturing overhead, $6,000. Total manufacturing cost, $225,000. Total cost per unit, $225,000 divided by 25,000 switches equal $9 per unit. So total cost per unit, it will be $9. This cost are incurred when we make 25,000 switches. Alternatively, the switches can be purchased for $8 per switch, $200,000. Thus, eliminates all variable costs of making switches and eliminates $100,000 of fixed cost. However, $50,000 remain as fixed cost. In the case of purchasing these switches, $8 per switch, we will purchase each switch by $8. All variable cost of making switches will be eliminated because we will buy, not to make. We will purchase. So all variable cost of making switches are eliminated. On the other hand, fixed cost, $60,000. 10,000 of fixed cost will eliminate and the 50,000 will remain. Total manufacturing cost is higher $1 than purchase price. Total manufacturing cost is $1 higher than purchase price. Purchase price $8 per switch. Manufacturing or making $9 per switch. 8, 9. 9 when we make, 8 when we purchase. Total manufacturing cost is $1 higher than purchase price. Must absorb at least $50,000 of fixed cost under either option. Two alternatives: make and buy. Make and buy. Items, cost items, direct material, direct labor, variable manufacturing cost, fixed manufacturing cost, purchase price, total annual cost. Under the first alternative, when we make the components, direct material 50,000, 75,000 direct labor, 40,000 variable, 6,000 fixed cost, no purchase price, zero, no purchase price because we will make the component parts. So total annual cost 225,000. Here, all of them are given in the exercise, in the example. All of these. Under the second alternative, when we buy, when we purchase the components, direct material, zero. Direct labor, zero. Variable manufacturing, zero. Fixed manufacturing cost, only $50,000. Only $50,000. Here, 10,000 will be eliminated of fixed cost. However, 50,000 will be remained. And purchasing price 25,000 multiply $8, $200,000. So in terms of the first alternative, when we make the components, the total annual cost 225,000. Under the purchasing alternative, $250,000 total annual cost. So obviously continue to make switches as purchasing adds 25,000 to cost. Purchasing or buying will add $25,000 to cost. Furthermore, we have to consider the opportunity cost. One kind of cost is called opportunity cost. We have to consider the opportunity cost. It refers to the potential benefit that may be obtained from following an alternative course of action must be considered in incremental analysis. Assume the same example. Assume that buying the switches allow the company to use the released capacity to earn $28,000 in additional income. The second alternative, the buying switches allow the company to use the released capacity to earn $28,000 in additional income. Buying allow the company to use released capacity to earn $28,000 in additional income. The $28,000 lost income is an additional cost of making the switches an opportunity cost. Here, under the first alternative, make 225,000 total annual cost, adding opportunity cost, so total cost will be 253,000, and buying 250, zero opportunity cost, 250 total cost. So when we take into consideration the opportunity cost, the decision will be changed. Buy the switches as company is 3,000 better off. Of course, when we buy the components, we will save $3,000 in the cost. We will save $3,000 in the cost. Hopefully you understand this lecture, and we will continue inshallah in another time.